Well, good. Let's get going. I'm John Henry, Chairman of the Committee for the Republic. Like Newton's preoccupation with the laws of motion, the Committee for the Republic is focused on war. Legalized first-degree murder is the worst of all evils. Controlling war is elusive without an understanding of the unflattering human narrative. Our species is made, as many of you know, of crooked timber. Driven by hormones rather than guided by reason, humans find self-esteem and purpose in the acquisition and maintenance of power. War for the sake of war. As Lord Tennyson said of the Light Brigade, theirs is not to reason why, theirs is but to do or die. And we're the only species that fight over straws on an industrial scale. Money is essential to the machinery of modern war, but Cain murdered Abel before the invention of money. The Greek war was said to be fought over a woman. Big banks did not even make a cameo appearance in Homer's Iliad. If all bankers and munition makers disappeared, wars would still be mankind's greatest scourge. That said, central banks nevertheless play an important role as paymasters of the warfare state. The Federal Reserve has reduced the already low threshold for war by using a fiat currency to allow the U.S. government to finance an empire without having to raise taxes. Borrowing between $1.5 trillion annually to support our imperial undertakings, you can argue has created most of our $31 trillion of debt. Americans will revolt if required to pay taxes for guns and butter. The Fed employs limitless discretionary power to expand its fiat currency. So to speak, the dual statutory mandate to promote stable prices and maximum employment simultaneously is as fatuous as squaring a circle. But the Fed's real top mandate, financing the government of which it is a part, is almost never mentioned. The role of the Fed in financing wars is clear in histories, but the Fed's success in performing that role is seldom discussed. And that's part of its success. The Fed represents a government of men and women, not a government of laws. Let there be no mistake, the Fed is unconstitutional. It has no independent constitutional standing. Congress has no authority to delegate control over monetary policy to the executive branch. The Fed violates separation of powers and in its present form should be abolished by Congress. The Open Market Committee, which is the Fed's boiler room for controlling the money supply, violates the appointments clause in the Constitution. Or if you want to look it up, it's Article 2, Section 2, Clause 2. The Committee for the Republic takes great pride in inviting the best Fed experts we can find to speak. And tonight's guest, Alex Pollock, and Alex unfortunately came down with COVID, and even though he looks healthy as hell, he's got a immune system of someone half his age, and he crushed it. And Howard Adler right here in front of me, they both fit the bill. Now their new book, Surprised Again, the COVID Crisis and the New Market Bubble. I just thought this was a fabulous book. And so we've asked them to come and explain, tell us about their book. And it's a vivid case study of how the Fed really swung into action during the pandemic. It'll give you a great insight into the Fed. And as I said, I think we have over kind of about 24 copies here. So Max will let you get it after the event. So come on, let's start now with Alex. You're going to go first, and then Howard.
Yes, that's right. Thank you, John. And many thanks for giving Howard and me the chance to share ideas about the profoundly important role of fiat currency central banks in financing the governments of which they're a part, and in particular, as you just said, financing war. And our new book, Surprised Again, has the Fed and its importance and central banks in general running through it, addressed both specifically and as part of many other of the questions. I'm sorry the COVID virus surprised me this week, but I'm delighted to be with you by video. The book Surprised Again has as one of its key themes the uncertainty, which is inevitable in all financial affairs. This is the uncertainty Frank Knight talked about, which means that you don't know the future, but you also don't even know the odds of the future. And this uncertainty guarantees that mistakes, including mistakes by central banks, including some really big mistakes by central banks, will definitely continue. We discuss the evolution of our Bagehothian and Nixonian monetary world, of which more anon. We discuss the history and lessons, very much featuring central banks, of the financial panic of 2020 and its aftermath, which is ongoing. We're still living with all of the results of the panic of 2020 and the government reactions and the resulting bubble markets and the resulting deflation of the bubbles. We have a chapter called Central Banking to the Max, which you might enjoy. Now, John has already said we hear a lot about the so-called dual mandate, but that's not the real top mandate of the Fed or the top mandate of all central banks. The top mandate is not stable prices or perpetual inflation at 2% or some other number, or promoting maximum employment or financial stability. It is, as John said, none of these, but to finance the government of which the central bank, in our case, the Fed, is a part. To finance the government of which the central bank is a part is the top and inevitable and essential mandate of central banks, including the Fed. And to do this, they have these days unlimited ability to print money, to finance government deficits as needed. And of course, the biggest creator of government deficits and of printing money by the central bank is war. Also, the central bank gets to create and inflation taxes on behalf of the government. And that's handy because that way the government doesn't have to vote for taxes. So convenient it is for governments to have central banks. So virtually all governments have one, and they are most especially convenient to finance wars. But in financing the government, and especially wars, although it's historically obvious this is so important a function, they're hardly ever mentioned in discussions by economists anyway of the central banks, and they are never mentioned in the public relations material, which is copious, put out by the Federal Reserve. It's obvious historically, but somehow doesn't get discussed. But we can say that wars are the most important events in history when it comes to finance. They have the biggest financial impact, they cause the biggest financial effects, and we discussed this in the book. Now, this goes all the way back with great clarity to the founding of the quintessential central bank, namely the Bank of England, founded in 1694. What caused the creation of the Bank of England? Well, it was because King William needed more money to carry on his wars with France. And so the Bank of England was set up with the main function of providing war loans to the government, and got in exchange the monopoly, or a monopoly, of issuing currency. And now after that, as time went on, the Bank of England became central to England's ability to carry out wars by financing them, including the wars against Napoleon. During those wars in 1797, perhaps little known, the Bank of England stopped redeeming its notes for gold because they were running out of gold, just like the US in 1971. And that set off a large inflation, which ran to 1821 when they did go back on gold. But it's clear that throughout the 19th century, an essential element of British world power was the Bank of England. This is very interestingly discussed, by the way, in the book The Pursuit of Power by William H. McNeill, who has a lot of detail on this. Well, in 1913, the Federal Reserve was founded principally to finance financial crises and to print up money to get through the financial crisis, but it didn't take long for it to become a principal actor in war finance, namely in 1917 and 1918, financing the American participation in World War I, which was followed, maybe not always remembered, by a terrific inflation in the late 19 teens. Now, another never spoken of mandate for the central bank is making money for the government by its currency monopoly. So if you can get your currency out into the hands of the public, it has a zero cost, basically. You can then invest the funds in interest-bearing assets. The currency outstanding of the Federal Reserve, that's to say US Federal Reserve notes, total about $2.2 trillion. Well, if you just could invest those at 3% minus your operating expenses that would automatically create about a $50 billion a year profit for the Fed, which they immediately turn into the Treasury and become a reduction in the deficit. Interestingly, right now, instead of a $50 billion profit, it looks like this year, 2023, the Federal Reserve will record a loss of something like $100 billion. That's an operating cash loss for the year, about $100 billion. Well, that's an amazing number, especially when you consider that the capital of the Fed is only $42 billion. So if that prediction comes true, they will be technically insolvent well before this year is out. Well, if we think about where we are in central banking history, I'd like to suggest two really fundamental influences. One is President Richard Nixon, who famously in August of 1971 defaulted on the American international agreements to redeem dollars for gold. That at the time was hugely controversial. It put the whole world onto a pure paper or fiat currency standard with no limitations on money creation, except the political decisions made in the central banks and in the government. So I like to say, in paraphrase of a famous statement, we are all Nixonians now. The entire monetary world is Nixonian, runs on a pure paper currency with no limitation, except how bad the inflation becomes from the printing. That is a control on that. So we have a Nixonian world. Nobody now questions that. Everybody takes it as just the way it is. And very few people ever suggest it should be any different. It's a really fascinating historical evolution. To that, I want to add Walter Bagehot, the great financial thinker of the 19th century, who in 1873 wrote the most interesting banking book ever written. That is Lombard Street. And in that he said, first of all, the central bank, in his case, the Bank of England, should always lend freely to quell a financial panic. And then he put other constraints on it. You have to have good collateral. It has to be at a penalty rate. But the constraints are mostly forgotten. The lesson that's taken in and has become gospel all over the world is the central bank not only should lend freely, but as Bagehot also argued, should promise that it will lend freely. Well, that's in principle and conceptually highly controversial. But nonetheless, it is the stated belief and practice of all central banks now. So we have a world which is both Nixonian and Bagehotian, and as the central banks have evolved in the last 30 years or so, has added a commitment to perpetual inflation. Now they say things like, well, it can only be 2%, but that's perpetual inflation. So I want to raise for you the question, in a life, which might be 80 years these days, a lifetime, what happens with 2% inflation? And there we experience the power of compound interest. And we found out average prices go up 5 times in one lifetime at 2%. So it's hardly stable prices. Now, sometimes we hear people say, oh, well, 2%, maybe that'll be too hard. So why not raise the target to 3 or 4% inflation? Well, in a lifetime, 3% inflation causes average prices to go up. Anybody know? 10 times. 4% inflation would cause them to go up 23 times. Well, these are really decisions of huge impact. And here is another constitutional question. Who has the constitutional power to decide that we're going to have stable prices, really stable, or we're going to have perpetual inflation, and if so, at what rate? The Fed has taken upon itself to announce to the country it's going to have 2% inflation forever. Of course, it hasn't succeeded in keeping it down to 2% by a long shot. And they have been abysmal in their forecasts of inflation over the last couple of years. But the point I wish to make here is, it is not the Fed's constitutional power to do that. Only the Congress is authorized by the Constitution to coin money, as they said in those days, to coin money and establish the value thereof. Somehow the Fed decided on its own it was going to establish the value of money and make a commitment to permanent inflation. Well, now, meantime, because of fundamental uncertainty, the central banks can't know what's going to happen. The future is uncertain for them, like everybody else. Their forecasts are equally as bad as everybody else's economic forecasts. Take as just one striking example, that in the spring of 2021, the Federal Reserve official forecast for short-term interest rates at the end of 2022 was, does anybody remember this number? It was 0.1%. And the range forecast by the members of the FOMC was 0.1 to 0.6. Of course, the outcome was 4.5%. So I guess that's something like a 45,000% mistake. But you have in the Federal Reserve the combination of tremendous power combined with inability to know what's really going to happen, and even what the results of their own actions will be, combined with an unconstitutional grabbing of the power, at least well, in the assertion and the fact of taking that power. We put this all together. We've got a fascinating institution which has evolved in a fully Nixonian and fully Bagehottian world, committed to perpetual inflation, but above all, committed to financing the deficits of the government, of which it is a part. And the biggest deficits of all are war, and the biggest moments of central bank expansion are during wars. Well, I'd say you have to say it's a serious situation, one that needs to be understood and maybe even reformed sometime, but it's certainly a key issue for everybody, but especially for the Committee for the Republic. And thanks so very much for having me. And Howard, I guess you're up.
Thanks, Alex.
First of all, I'd like to express my thanks again on behalf of Alex and myself to the committee for having us here tonight, to John Henry for arranging everything and for reaching out to us. We're delighted to be here. The Federal Reserve balance sheet is currently at about 8.4 trillion, while the national debt is more than 31 trillion. These are staggering amounts that will make it more difficult to deal with the next financial crisis. And the next financial crisis is inevitable. It's going to come. In the 1970s, economic historian Charles Kindleberger noted that financial crises happen roughly every 10 years. And that has been our recent experience, with crises occurring in 2007 to 2009 and 2020. As Alex noted, in dealing with the 2020 financial crisis, the government followed Walter Bagehot's principle of lending freely, injecting about 5 trillion into the economy through 36 Treasury and Federal Reserve emergency lending programs. The Federal Reserve and the Treasury work together. The Treasury borrows money and the Federal Reserve prints up money to purchase the Treasury's debt. This is how the Fed finances the government. This is the result of bloating the Fed's balance sheet. As a result of COVID responses, by March 2022, the Fed's balance sheet was an historically unprecedented 8.9 trillion, with about 5.7 trillion in Treasury debt and about 2.7 trillion in mortgage-backed securities. The national debt was more than 30 trillion. This is a sophisticated audience, but I'm going to just take a minute and just try to emphasize how big $1 trillion is. When I was practicing law at Gibson, Dunn & Crutcher, M&A law, I'd do a $1 billion or $2 or $3 billion deal, and I'd be staggered by how much money that is. But $1 trillion is 1,000 billion. It's really a lot of money. It is nothing to sneeze at. In August 2008, before the Lehman crisis, the Fed's balance sheet was only about 900 billion. But then the Fed began to monetize government bonds by buying them, including government guaranteed mortgage bonds. This was called quantitative easing. Fed Chairman Ben Bernanke explained this very candidly by saying that it was to basically pay the government's bills through money creation. Investing in long-term fixed rate assets and funding them with floating rate deposits had the effect of making the Federal Reserve the world's largest savings and loan, and that's what it is today. As an aside, like savings and loans in the late 1980s, the Fed were a normal commercial entity would be bankrupt today. As Alex mentioned, it's running a $1.3 trillion mark-to-market deficit because its assets consist largely of low interest rate securities in an environment of rising interest rates. Its portfolio has suffered about 1.3 trillion in mark-to-market losses. The Fed is only 42 billion, as Alex also mentioned, in capital. And in 2023, it's facing about $100 billion operating deficit. So it would be bankrupt if it were a bank or an S&L. But it isn't a commercial entity. And when the Fed has to pay its bills, it merely prints the money to do so. It does not have to mark the securities on its balance sheet to market. And instead of taking its operating loss as a loss and charging it off against its capital, which would result in a big negative capital number, the Fed, through the magic of government accounting, treats it as an intangible asset, which it very uncreatively calls deferred asset. But this isn't an asset at all. It's just a huge loss. And only in the bizarre netherworld of United States government accounting could this be treated as an asset. So this is something like the fact that Alex mentioned, that the Fed exists primarily to finance the United States government. It's something that you will not hear Chairman Powell mention in any of his press conferences. Anyway, back to our story. The quantitative easing program was supposed to be temporary and the Fed's balance sheet was supposed to normalize, but it didn't. The balance sheet level rose to more than $4 trillion in 2014 and was reduced only to $3.8 trillion in August 2018 before the COVID crisis hit. Why does it take so long for the Fed's balance sheet to go down? Well, that's because the Fed does not sell off its treasury or mortgage debt, because doing so would likely disrupt the treasury and housing market, and the Fed does not want to do that. The Fed also wants to avoid taking obvious losses on debt that has gone down in value due to rising interest rates. For these reasons, the Fed prefers to reduce its balance sheet by letting its debt mature, leading to very slow declines. As a result, when the next financial crisis occurs, the Fed's balance sheet will still be inflated from its efforts to contain the previous one, and the level of the national debt will doubtless be high. There are two immutable laws of economics. Nothing is infinite and nothing is free. The U.S. is a wealthy nation, which allowed it to weather the COVID crisis by borrowing. We're all lucky to live in the United States, make no doubt about that, to have that advantage. The dollar's status as the world's reserve currency means that foreign central banks hold most of their foreign reserves in dollars in the form of treasury debt, and the dollar is the currency of choice for international transactions. These factors create very high demand for treasury debt, but that demand is not infinite. It also cannot be a healthy sign that such a high percentage of the national debt is held by the Federal Reserve. The dollar also faces increasing competition from the currencies of other nations, such as the Chinese yuan. I was in the conversations before this meeting. One of your members was good enough to point out that the 30-year Treasury auction that occurred, I believe today, ran into some trouble. There was less demand than people anticipated. That goes to my point that even the demand for treasuries cannot be infinite. As the national debt increases, demand for treasury debt must at some point diminish, and interest rates on such debt must rise, resulting in a crushing interest rate burden on the U.S. economy and increased inflation. The Federal Reserve also can't infinitely expand its balance sheet and thus the supply of money without causing inflation. And at some point, it will not be able to buy additional amounts of treasury debt without causing the interest rate demanded by others on such debt to rise appreciably. All of this suggests that the U.S. may one day face a financial crisis without sufficient wealth and the wherewithal to issue enormous amounts of debt and print enormous amounts of money, as we did to stave off the 2020 crisis. The result would be runaway inflation and economic catastrophe. The obvious answer is to reduce federal spending, thereby lowering the national debt as a percentage of GDP and allowing the Fed's balance sheet to run down more quickly. But unfortunately, the folks who work a block southeast of here show no intention of doing so. Thank you. Alex and I would be very pleased to take any questions that you have about anything we've said or anything that we haven't said.
I see my wife. Okay.
Okay, I'll give the first one. I want to draw a line underneath what this argument is. Are you saying that, I mean, historically, the Anglo-Saxon countries, the UK and the US, have been very proud of the independence of their central banks. And countries that do not have independent central banks run up massive deficits and are printing money like crazy. So is your argument that we have now lost an independent central bank and we're in the same ballpark as Venezuela or other countries where we just simply finance all this profligate government spending?
Alex, if you want to take the first crack at this, I have some things I'd like to say too.
With pleasure. We never had a totally independent central bank. It's a nice line. Arthur Burns, the chairman of the Fed, who presided over the great inflation of the 1970s, famously said, "We can't exercise our independence for fear of losing it." And before that, in the 50s, William McChesney Martin used to say, the Federal Reserve is independent within the government, which if you can figure out exactly what that means, it means they're not really independent. And we just have to face up to the reality of that. And that's especially true in wartime, because in wartime, then they're in between, they have some ability to operate independently. But once the war is on, they become the pure minions of the United States Treasury and basically do what they're told.
I just like to I also believe that the Fed's independence is largely a myth, because when your governors are appointed by a political figure, how independent can you ever be? Let's go back and take a look at where we were when the Biden administration took over from the Trump administration. Jay Powell was the chairman of the Fed, is the chairman of the Fed. And let me just say a few things about Jay Powell. I think he's a great Fed chairman. I've known him for a long time. When I was in private practice, I had the pleasure of representing him when he was at Carlyle on a number of deals. He's a very smart guy. He's a very conscientious guy, and he's a warrior. I love a warrior. It's a perfect job to be. I was always a warrior when I practiced law. I think that people who worry about things get the best results, and he is the kind of person who who stays up at night worrying about his job and how to be a good public steward. But at the end of the Trump administration, you had Secretary Mnuchin starting to urge that this flow of liquidity, this borrowing to fund the COVID crisis, stop. The crisis was over. It was time to go home. Alex and I, in our book, called that the Cincinnatus principle. That's after the famous Roman general Cincinnatus, who was called from his farm to save the Roman Republic from an invasion, did it in 15 days, and then went home. George Washington refusing to be the king of America and going back to Mount Vernon at the end of his term as president, another example of the Cincinnatus principle. Unfortunately, when in the new administration with the American Rescue Plan, adding another 1.9 trillion to the debt and expenditures, we continued to fund liquidity when it was to put liquidity when it was no longer necessary. And at that point, where was Jay Powell? He was up for reappointment. If he had wanted to raise interest rates, my guess, and this is just my guess, is that he could not have probably gotten a majority among the Fed governors to do so. He certainly would not have been reappointed. The person who would likely have been reappointed was considerably in favor of greater spending than Jay Powell may have been in favor of. He's, after all, originally a Republican. But what choice did he have? If he wanted to be reappointed in a political arena, what was he? And so he said nothing. And more money was spent, and now we see him playing a little bit of catch up and tightening. But what was he to do? And how can, given that history, how can you really say that the Fed is independent in a situation like that. If you were independent and appointed by, Brahmins or philosopher kings and had nothing to do with politics, you would look at the situation and said perhaps we should have tightened a little more quickly. But unfortunately, the Fed is not out of politics and it's not divorced from the political scene.
Bruce Fine, our vice chairman.
Just one observation that even if the Fed were all geniuses, we decided in 1787 not to have a rule by Platonic guardians, no matter how smart they were. The Fed is not elected like members of Congress are. It's the reason why the currency and the value of the currency was entrusted to elected representatives. They could do really stupid things, but we can vote them out of office and they're accountable. There's a dignity to charting your own destiny, not being let off a cliff by Platonic guardians. The second question I had in regard to this fear that if you entrusted the currency to the Congress, and remember, we didn't have the Fed for like 100 and some years. It was 1913 and the Constitution began 1791. So over a century, we seem to survive without a central bank. But in post-World War I Germany, when you had the massive inflation, I guess in part to diminish the cost of reparations, was that the German central bank? Was it the Reichstag? Who was printing that money? Just to try to compare the responsibilities of elected officials as opposed to appointed ones.
You want me to start?
Sure.
Well, first of all, the point about being brilliant puts me in mind of one of my favorite laws or principles, and it is this: it's easier to be brilliant than right. And no matter how brilliant you are, how well educated, how well informed, when it comes to dealing with the financial future, in my opinion, you will get it wrong reasonably often. And even it's not a matter of bad intentions. You can be completely well-intentioned, but still make terrific mistakes. And in retrospect, when you look at financial crises, some of the biggest mistakes are made by some of the most brilliant, best educated people. And so I would say, Bruce, that backs up your notion of the difference between elected representatives and, let's say, Wilsonian, as in Woodrow Wilsonian, supposed technical experts to run things.
Yeah.
I'm sorry. And on the Weimar Republic, of course, it was the German central bank. I guess it was the Reichsbank in those days. Of course, it also was operating in a web of political relationships inside the German government.
And, I don't really want to make, I talked a little bit about the appointment process as a diminution of the independence of the Fed, and I think that is certainly the case. But of course, once the governors are appointed and they're serving their, I forget, 4 or 5 year terms, then they have no oversight. In effect, there is no congressional oversight, and they sort of do what they want. Their only constraint being that I suspect some of them may want to be reappointed again when their term is up. So the point that John Henry made at the beginning, and that you made, Bruce, that oversight is a good idea. I certainly wouldn't argue with you, because the amount of oversight that is exercised by the Fed in between the appointment process is minimal, if non-existent.
Sure. Thank you. One of the problems clearly with the public is that they see a very strong dollar and say, what's the problem? I wonder what you think about China, which really does want to have the renminbi or yuan challenge or replace the dollar? And how would you assess the actions of the Chinese central bank, Chinese government over the past year? President Xi went to Saudi Arabia and they're going to pay for some of their oil apparently in renminbi. Do you see the renminbi as really challenging the dollar?
Can I take the first shot at this, Alex?
I can, but let me just say that our book extensively discusses this issue, and those are in chapters drafted by Howard. So you should definitely take it.
Okay, you are absolutely right. We argue that the dollar is under assault largely from the renminbi, the yuan. I guess that yuan is their international currency, and you see this a lot in the context of the Chinese are going towards a central bank digital currency called the digital yuan, which they want to use internationally. And you see that you figure the digital yuan, and the yuan essentially puts your finances not under the control of the rather benign United States Congress, but the Chinese Communist Party. And who in their right mind would want their financial transactions subject to the Chinese Communist Party? But it turns out there are a lot of people who would. And that's partially because of the United States sanctions program. There are a lot of people out there who are either being sanctioned or afraid that they will be sanctioned. Obviously, Venezuela, North Korea, Iran, Russia, China, and people in those are who have been sanctioned, and other people fear that they've been sanctioned. You hear from the Brazilians that they fear that they may be sanctioned in the future because of their policies in the Amazon. So there is a great deal of concern out there about what's been called dollar weaponization. So that's one threat to the dollar. And obviously the Chinese and the Russians are trying to do whatever they can to get people not to use the dollar. The Chinese have another hook because of their Belt and Road program. They've lent enormous amounts of money to various developing countries, largely developing countries, also developed countries. They put a lot of money out there. But in the case of the developing country that may owe a lot of money to China, they have a lot of control over that economy, and they may demand in the future that those countries start using the yuan for international transactions rather than the dollar. So I guess the last figures I saw from the BIS said that the dollar was used in 88% of international transactions and the yuan in about 4%. There's a big discrepancy. And when the euro came out in the 90s, people thought that, the euro would replace the dollar to some extent, but it really hasn't to a large degree. But so there's a lot of ground for the Chinese to make up. But should you be worried about it? Sure. I mean, I'm sure I know folks in the Treasury and the Fed are worried about it.
However, if you were a subject of Great Britain in 1914, prior to August, you'd have thought it was obvious that the pound sterling not only was, but would continue to be the globally dominant currency, and that London would be the world's center of finance and capital allocation.
So I wanted to just follow up on this because anyone who writes a book, Surprised Again, will obviously not like this question because it, but
you may be surprised at our answer.
I'm looking forward to it. So Chaz Freeman, our chairman emeritus, puts out the listserv, and I don't know how many of you read it, but I read it religiously. And I don't know, when we first started doing this, there might have been one article a year on the dollar being replaced as a reserve currency. And then, then it was once a month, and now, and then it was once a day. I would say Chaz is putting up 2 or 3 articles every day on how either the Russians or Chinese or the BRICS countries. So when I'm asking you, it's a timing question. And I had a partner who said to me, he said, it's just timing. And I said, what do you mean? It's just timing. It's that's who you marry. That's how rich you are. Timing's everything. So, and you appreciate that with your book, but I just get the sense of with the Ukraine situation and seizing the Russian asset. I just get the sense from, if you just look at the amount of articles press on this issue on our listserv alone as a barometer, it's quite noteworthy.
Well, it's a serious issue, but of course, John, as you say, the timing is always a problem, and you may feel you can see crises coming, but you know you'll be fooled by the timing of them. As we discuss in the book, however, all of the experts are regularly surprised by financial events. This might work out in a way that we just haven't figured out yet. But as to articles correctly predicting change, think how many articles have been written in the past decades about the looming insolvency of Social Security and Medicare. But it doesn't seem to be happening yet, even though they're massively insolvent.
Okay. Bert, we have a financial expert here.
Yeah, Alex, thank you.
And a good friend.
But Alex and I have been talking about these issues for probably 40 years. But, so it's good to be with you tonight. One of the things that's happened at the Fed in just the last few years has become much more active in manipulating interest rates across the entire yield curve. What do you both of you feel is the longer term significance of that greater degree of activity in terms of manipulating interest rates, particularly holding down longer term interest rates, such as mortgage rates? And how might this play out over the next few years?
You want me to start on that, Howard?
Sure, go ahead.
First of all, we can say it's different than shortly before, and certainly different from the Fed of William McChesney Martin, who thought the only thing the Fed should own were treasury bills, that is to say, short-term treasuries, because he thought the Fed should interfere as little as possible with the allocation of capital. Well, part of what's going on with the buying of long-term assets is an attempted and a carried out allocation of capital. For example, to housing. That's picking a sector and subsidizing it through the central bank and its monetary power. And one of the results of that was an incredible second housing bubble. The second, we have had now 2 housing bubbles in the 21st century. And that's still playing out a huge distortion. Another effect of the buying mortgages, we're buying 30-year mortgages. These are very long-term fixed rate investments, and they're buying long-term treasury bonds, a lot of them more than 10 years. The Fed, I think I'm remembering the number right, the Fed owns $4 trillion of a very long-term mortgages with maturities of more than, I'll leave it at that because I don't remember the exact number, but a very long-term fixed rate mortgages, which they're now financing at much higher short-term interest rates, so that their interest income is less than their interest expense. And it's very hard to make money that way. So it's affected the Fed's own profits and losses, namely making them into losses. Those Fed losses are in fact taxpayer losses, because as Bert taught me some years ago, you have to think of the Federal Reserve and the Treasury really as one thing, and imagine them being the consolidated financial government. And then all of the intra-government transactions disappear. They're consolidating eliminations. And what you're left is the Treasury spending money and the Fed printing it up so they can spend it, or the Treasury funding mortgages and the Fed printing up the money to fund those.
Yeah, I just, housing's sort of the only area in which the Fed has directly intervened other than in the Treasury market. And again, as Alex pointed out, when William McChesney Martin in the 60s was asked to buy Freddie and Fannie debt securities, he refused. He said he didn't think that the central bank ought to be in the business of propping up one sector of the economy. One thing that we all fear is, and one of the consequences of the possible digital dollar, a Fed central bank digital currency, is that the Fed will be taking on, if it's done, it will be taking on deposit liabilities. And if it takes on deposit liabilities, it will have to have assets to match against those deposit liabilities. And that raises the ugly specter of credit allocation. Would the Fed be tempted to intervene in markets other than housing, preferred markets, for example, in the current time, green energy, and not allow loans from the central bank or made by banks that are funded by central bank deposits to invest in gas or oil, or in politically disfavored industries. And that's something we have Fed creep, that it's something we really have to keep an eye on. And on one of Alex and I have both written a number of op-ed pieces, and we talk in the book about we're not in favor of the Fed having its own central bank digital currency, because we'd like to avoid that kind of Fed creep.
Well, Howard, certainly it was about 50-50, right, between buying the treasuries before the pandemic, right, and the housing, right?
I think more heavily weighted to treasuries and housing, but still,
But then it just,
multi-trillion dollars in both
Right.
categories.
But basically, when you said that the housing sector is the only sector that has been identified as singled out for, I think Alex's whole presentation was that we not call it, so, we have an invisible empire, right? Because if the tree falls in the woods and no one's there to hear it, did it make a sound? And so the Fed makes all this massive military spending invisible to the people. And so I would say that even though it's not designated,
Right.
It doesn't have a name on the door, like, housing, we're subsidizing housing, but this as Alex said so eloquently, it's just never said, right? There's never been a Federal Reserve press release that's ever said where this $1.5 trillion that we're basically borrowing every year is going. So
You're absolutely right. I mean, to the extent that the government is buying whatever the latest F is from Lockheed Martin or companies like that, those purchases are being funded by the Fed, and thus those industries are being indirectly funded by the Fed.
you're right, because I kind of view the military industrial complex as a massive industrial policy. Yeah. Okay, Pat.
Two quick questions and then a longer question. First, was the Treasury at one point on the Federal Reserve Board? Secondly,
Answer that. Let's just answer it as we go. Yes, under the original Federal Reserve Act of 1913, the Secretary of the Treasury was automatically chairman of the Federal Reserve Board.
when did that change?
Changed in 1935.
Okay. Now, secondly, you talked about the Fed, the governors, 7 of them are appointed and confirmed by the Senate. The Open Market Committee, how is that 11 people? Are there 4 people who are not confirmed by the Senate? And how do they get appointed to be on the Open Market Committee?
It's 7 and 6. They are the presidents of the Federal Reserve banks and they rotate in an ordered rotation. So some are voting at any one time. And
Does the president appoint the chairman of the federal, of the banks around the country?
no, they're elected by the boards of directors of the local bank with approval of the Federal Reserve Board.
Okay, now, then the other key question comes into with reserve currency. If the United States was not the reserve currency, would we be able to run massive and ongoing trade deficits? I think we've run about 9 trillion with China since they came into the WTO. And would we be able to get involved in these very expensive foreign wars like Iraq and Afghanistan? Or would that be restrained if we were not the reserve currency?
If we weren't the reserve currency, these very expensive wars would be much more expensive because we'd be paying the reserve currency. Being the reserve currency creates a great demand for treasury debt. And that means that the interest rate is lower on the treasury debt than it would ordinarily be. In the 1960s, the French called this
Extravagant privilege.
extravagant privilege, exactly. And that's what it is. So we basically, because with the reserve currency, our whole economy is subsidized because we borrow a little bit lower. If we weren't the reserve currency, we'd be paying a higher interest rate because there's much less demand for our debt.
Would that be restraint on that?
Well, now that's an interesting question, because if you look historically, let's say under the gold standard, if they had stuck to the gold standard in 1914 and following years, they wouldn't have been able to fight as long or as with such horrible destructive outcomes. But what happened? Well, all of the European countries went off gold and printed up the money and created terrific inflations to finance the war. I have to say, just maybe I should slip this in. In 1914, when they were sending the British Expeditionary Force to fight in World War I, they had the first big bond issue, which they offered to the public. And it was only about 1/3 subscribed. So what do you think happened? The Bank of England fraudulently pretended that the bonds were being bought by individual employees or officers of the bank, but actually the bank itself bought them and monetized them. They did not disclose this, and in fact, led, I think it was the Times of London in those days, one of the major newspapers, to run an article talking about the oversubscribed bond issue, which was just a lie. And John Maynard Keynes, in reviewing this, he was of course an elite insider, called it I think it was a magnificent manipulation was his term for this fraud carried out by the world's top central bank at the time. So I wrote an article about this a few years ago, the title of which was, "Is it all right to lie for your country?"
And of course, you're seeing this skepticism about the Fed's veracity play out now in the markets. The markets, when the Fed is talking about taking a tougher line on inflation and higher rates for longer, you're seeing the stock market and the bond market, most importantly, not believing that fully, and so we have a stock market rally and a bond price rally because they're a little bit skeptical. If the Fed were to say that, oh, things are looking better, then it would make their job harder to do in the future. So there is there are constraints against the Fed being completely honest in what it is doing. And right now, you've been reading, and it's been written about 1 million times last month, basically there's a lot of skepticism about the veracity of the Fed, and the market and the Fed are saying very different things.
Thank you.
John?
I wonder if I could, I wonder if I could come back to the essential purpose of the Fed. The Fed was not created to finance Treasury. And in fact, the basic reason for the Fed being created in 1913 was explained in great depth by your former colleague, Carmen Reinhardt, in a great book called This Time is Different, subtitled 800 Years of Financial Folly. As you may recall, in the 19th century, there were 6 financial crises followed by depression. The one that led to the Fed was 1907, which led to a depression. And the Fed was designed essentially to prevent the need to have recourse to private bankers like JP Morgan. And I worked as the international economist for an investment bank founded by JP Morgan. And subsequently, the Fed has been forced to intervene in financial crises, almost always caused by the smartest guys in the room who find their way around the 5 different regulators and inadequate mandates given by Congress to regulate and supervise the financial institutions. Let me bring it up to date. Dodd-Frank resulted from the financial crisis of 2007-9. And as John Henry and I found out, 2,000 pages of regulations exempted essentially the non-banking financial sector, but it did improve capital ratios for the banking system. So today, the US banking system is in far better shape than it had been. Let me come to another more basic question, and that is Congress, which this group has said again and again, make Congress great again. In fact, I proudly wear the cap saying, make Congress great again. Congress, not only the question of war, but in the question of supervising the financial sector and also raising taxes. The US has the smallest tax burden of any major country today. And the result is continuing deficits. And that's particularly important since our productivity and demographics mean that our potential non-inflationary growth is only 2%. So the Fed has to step up where Congress fails to step up. And to the extent that the Fed does that successfully, it enables the politicians in Congress to abdicate their responsibility for their fiscal responsibility. So I would argue strenuously that the Fed has a vital role in protecting the financial stability of this country, which is essential to the economy and to its political system.
I think I talked about this in my remarks, so maybe I'll take the first answer. I said in my remarks in 1913, the Fed was set up, as you rightly point out, to be able to create money to address the inevitably cycling crises and panics. But that lasted only, that lack of financing the government in the Fed's actions, as I also said, lasted only until 1917, when they made their name and their political popularity and they're becoming somebody important inside the government. You remember when the Federal Reserve original governors complained about the order that they were going to get to enter a state dinner in, which was down the hierarchy. Woodrow Wilson replied, they can come in right after the fire department. But they became very much more important starting in 1917, and indeed every time there was a war, and in between financing the government as needed. So that in my opinion, that natural relationship came out. Now, they also are trying to do all the things you say, but with a very checkered record, one would have to say, as my old friend Bernard Shaw wrote a great book on the Fed, said, the more inflationary and deflationary blunders the Fed makes, the more power they obtain.
I just wanted to dig down a little bit into one of the things you said, Paul, about Dodd-Frank. It is absolutely right that Dodd-Frank and the regulations have made our banks safer, and that's good because That's the taxpayers are responsible for our banks, but the way they've done it is by taking all of the risky things that banks used to do and driving them into the unregulated part of the economy. Now you have large Wall Street companies making the risky leverage loans. You have loans held by investors in CLOs. Mortgage origination and servicing is largely gone outside of the banks. That was all the risky stuff. And one of the scary things, Alex and I and the government were part of the financial stability infrastructure that was set up after Dodd-Frank. I ran the staff of the Financial Stability Oversight Council at Treasury, and Alex was the principal deputy director of OFR, the entity that did the financial and economic research to back up FSOC. So we were both, financial stability bureaucrats, and we don't really know what's going to happen if there are failures in that. Our book describes it as terra incognita. We just don't know because we've never had it before. If these companies fail the way the banks have failed repeatedly when they were doing riskier things, what happens? What are the interactions? What are the interactions with the regular banks? Well, they're extensive, and the book goes into some of them. But we just don't know. So it's a brave new world. And until we see, one day there's going to be a problem in that sector, and we're going to find out what happens. But until then, I'm afraid we can only speculate it. Maybe it's better, maybe it's not.
I might add just one thought that while mortgage servicing went out to the mortgage servicing non-bank companies, the funding of mortgages left the banks and went into the Fed.
Yes, but this is the result of Congress failing to enable regulation of the non-banking financial sector. There was, during the legislation leading to Dodd-Frank, you recall that the non-bank financial sector was in fact effectively eliminated from effective supervision. We see Congress again and again failing to fund the IRS, very basically, for instance. We see them arguing against any further supervision of this very affluent and influential K Street sector that now generates more credit than the banking sector does. And so the Fed has to operate against this. The Fed itself says it doesn't understand that sector very well. So we have a huge problem, again, caused by Congress's failure to regulate and supervise a sector which is out of control.
Well, it depends how they regulate and supervise it. If some of these companies were to fail and there isn't an interconnective effect, they fail, and that's good. That's capitalism working. If Congress were to have then put them under the rubric of the safety net, making taxpayers responsible for them and telling them what they could do, I would suspect that another sector to deal with that risk would have developed, ad infinitum to avoid that regulation. So I'm not really sure what the right answer is.
Warren Coates is online here, and Warren is on our board, and Warren did a great salon last year where he's Mr. SDR, and we thought the SDR was a nice angle to kind of come in and land on this subject of the reserve currency. So Warren, it's all yours.
Thank you. Several different points that I would like to make. With regard to the last issue of shifting risks from the banking sector to others, I think that's a good thing. The banking system is funded largely by our deposits, and therefore it's appropriate that they be much safer, more prudent, and that our deposits are always secure. If direct investors are taking the risk, that's much better than a bank doing so on the basis of my deposits. Another comment on a different aspect of this discussion is that I think everyone here probably really agrees that most of the blame for our situation is with the government, with Congress, with the fiscal policy, excessive spending, requiring all of this financing, The Fed is sort of sucked in, dragged along, despite legal protections that are meant to preserve their relative independence. It is against the law for the Federal Reserve to lend money to the government directly. They must buy government debt from the market. Now, you might think that comes down to pretty much the same thing, but it is at least an arm's length separation. The Federal Reserve has a congressionally given mandate of what their job is supposed to be, which is price stability. They are held accountable through twice annual congressional testimony where they have to explain how they fulfilled their mandate, or if they didn't, why they didn't. So there is an element of accountability there. The Fed governors, not the presidents of the central bank that are on the Open Market Committee, but the Fed governors have terms, it's either 12 or 14 years. I can't
14.
remember. 14? Thank you, yes. So, I mean, this is an effort to minimize political interference. Now, obviously, that's not fully possible. They are a part of the government, and politics does have its influence. This is why I have always been supportive of currency boards, which is a very rule-driven version of a gold standard, not necessarily anchored to gold, but the same idea that it is the public, the market, through their behavior that determine the money supply, given the legally mandated anchor for which that money can be purchased and redeemed. That's what currency boards are about. I gave such a system to Bosnia and Herzegovina, and while everything else there seems to go wrong, the monetary system is in good shape.
Well, Warren, you're recommending the exact opposite of the Nixonian world post 1971. Also, on the interaction between the Fed and the government, there's a famous event, which is when Lyndon Johnson was president, was ramping up his domestic spending and his war, and the Fed raised interest rates when he didn't want them to, and he invited William McChesney Martin, the Fed chairman, down to his ranch in Texas, and at least according to some descriptions, physically shoved him around his living room while yelling at him.
Yeah.
That's a great scene to imagine.
Yeah. That was LBJ.
Yeah.
Well, I don't have much to add, but the distinction between loans and buying debt, there's a really an interesting analogy. When I was in private practice, I spent some time doing sovereign loans to South America, and most South American countries have a constitutional prohibition from borrowing. And so how do these countries borrow and run up the debt? Well, with the help of some clever American lawyers, the attorney generals of those countries came to the conclusion that selling notes was not making a loan, was not taking a loan. And so all of these loans were structured as the sale of notes, because after all, the note was simply an asset that these countries were selling. Obviously, there's absolutely no distinction, economic distinction between borrowing and selling a note, and that sort of reminiscent of how people get around the Fed borrowing, the Fed lending prohibition.
Well, I want to thank you both for giving us a great in-depth look at the Fed. It's a extremely complex institution, and it's related to so many other complex things. But you guys did a great job of practicing making it simple without doing violence to the complexity. Thank you, Alex, Howard.